Today, we're going to do a real deep dive on what to expect for Tesla's 2024 auto margins. There's a list of 10 price and 4 cost levers that we will show. We're also going to compare Tesla's research and development budget, both real dollar amounts and percentage of revenue, as it compares to the other 6 Magnificent 7 companies. You'll be shocked to learn just how much Tesla is able to achieve with relatively little investments. Today, we've got Jeff Lutz with us, and we're going to ask him these questions because there's no one else part of the Tesla retail community that knows most about supply chain, about cost, about margins and factories. Welcome, Jeff.
Yeah, great to be with you, Herbert. It's a cool topic. Love it.
Yeah, Jeff is a C-level supply chain executive. He's previously a chief quality officer as well at multiple Fortune 100 companies. And today we get to take advantage of his knowledge, which he normally charges big consulting bucks for. So I love this tweet from James Catt. I thought it was really well timed and well written. James says that, he believes that the 2024 margins, the auto gross margins for Tesla, will come down to these factors. And I thought it was a really well done kind of summary, right? So there's the things that's going to impact price, and there's things that are going to impact cost. So first, in terms of the price of the car, there's going to be the IRA point of sale in the US. You've been pointing this out quite a bit, Jeff, reminding folks that by January 1st, it's now going to be point of sale. So all of a sudden, the actual, MSRP of the price of the car will be down, although we did hear that the Model 3s is no longer going to be part of the $7,500, but for other versions, it will be. The Model 3 Highland is going to come to the US. Lower interest rates. We know that the economy is, there's now signals that there's going to be 3 price cuts, interest rate cuts next year. The weaker US dollars, the Model Y and Model 3 sales mix. You can explain that a little bit. The Cybertruck's higher ASP and greater FSD penetration with V12. What's your points in thinking about these lists?
Yeah, and there's another one too. I posted that Canada is, I think tomorrow they're going to announce that they're going, fully.
Yes.
I don't know if it's fully electric, but they want to get off of pure ICE. And there's debate about what they're actually going to do, but they're pushing for more and more, EV-like vehicles. I think by 2026 they want to be 20% of their mix. They're currently at 8.5%. EV today, and they want to get to 60% by I think 2030, and then 100% by 2035. So you have this. It's really the first point of you have governments now globally, but in the U.S., well, the IRA going to point of sale means that consumers are going to walk in and they're going to agree to purchase a Model Y, and they're going to drive off with a $7,500 credit in invoice. Before it was a tax credit you claim later. So it would be in your monthly payment for a year or more. So this is a big deal that it's coming to point of sale. It brings that cost down right away, which what is everybody kind of sensitive to? They're sensitive to their monthly payment. So that's a big one. The Model 3 Highland, this one changes the dynamics of the, of the gross margin structure, unit economics of building that vehicle. I believe that they stripped out a bunch of cost. I believe they've added some features, and they're going to be able to charge more for the vehicle. And I believe they've taken their cost structure down. And yet they still have, I think, greater than 50% reuse from the current Model 3. So they're going to be able to reuse a lot of the capital, a lot of the tooling in the core structure of the vehicle. That's where a lot of the cost structure comes from to build the vehicle. And they were able to add these other features in that can help boost the MSRP. So I actually think this is going to do pretty well with or without the credit. And remember, when those Panasonic cells are being built, in the US, all those cells, Tesla still maintains that credit. And it's a question of which of the Model 3 vehicle. I think the long range and the rear wheel drive are the ones, and that's most of the volume. That may lose this credit, and the performance will maintain it. But there's 2 things. There's the consumer credit, and then there's the advanced manufacturing credit that Tesla gets for cell production and pack assembly in the US. And they're still going to be able to maintain that across these vehicles. The lower interest rates, that's going to be a big one. This one's going to play out over time, though. So there's, some people, there's a camp that believes that we're going to get our first interest rate cuts by March. and then the nominal belief is somewhere around May or June. Obviously, that's going to take the monthly cost of the vehicle down. The U.S. dollar is going to help from an earnings perspective. The weaker dollar as a result of the rates coming down and so forth. The Y going, the Model Y3 sales mix going more to Y. The higher ASP of the Cybertruck, that's going to help. I mean, ASPs have done nothing but come down. And then finally, FSD penetration. I've been talking about this for a while. As FSD improves, you're going to see that first off, we've been miscalling the FSD penetration rate. I don't know, forever. The last time that Tesla actually reported out on this, which was the January earnings call of this year, they basically said 24% of the Teslas on the road in North America have taken the FSD download. So for whatever reason, there's this 8% global number that's put out there. Those are in regions where FSD doesn't exist yet, and there's different packages. So these are all things I think I agree with these factors. I think James Cat's a great account, by the way, to follow. And I have cats. I love cats, and I think it's a great account. Let's go through the other side of it.
The other side of it. So I finally figured out what he meant by Model Y3 sales mix, because the Model 3 is going to lose the IRA credit. So there might be increase in Model Y because the prices are going to be fairly similar. And then that's actually better because Tesla makes more margin on it. So if we look at the things that are going to affect the price, we are going to lose the $7,500 Model 3 IRA credit. So that's going to be an impact on margins. Also in Germany, also in France for the Model 3. Although he thinks that maybe Tesla will ship the Model 3s to Europe from Fremont. Maybe that will be one way to still be able to still take advantage of these.
For sure. And that's what they used to do.
Okay. And then in terms of cost, this is your space. You've been talking about it, but there's going to be a reduction in commodities, in transportation costs, fixed production costs. I don't know why he said that there's going to be no more increase in manufacturing labor costs. That's what he means.
No, I don't think I think he's saying that there would be an increase. I don't know, maybe he's calling out Cybertruck, maybe he's calling I don't know exactly, but I agree with the commodity side of it. As the recovery occurs globally, that commodity side has continued to stabilize and should be in good shape. But I just think people should realize, for example, with the tonnage of steel, when Cybertruck was originally unveiled in 2019 to now, I think steel's up 35 to 45% on a tonnage cost per tonnage basis. So some of this is kind of a mixed bag, but I know he's looking at 23 to 24, and I tend to agree with the direction of these arrows. In terms of the labor piece of it, I'm not sure I get other than maybe that's probably the UAW, piece of it of basically the UAW shops increase all their labor, their wage rates, and then a lot of the non-UAW shops have also, and so there'll be pressure on labor rates. I get that. But Tesla's going to continue focusing on labor efficiency. The other piece of it will just be, and he called us out, I think, but just the capital efficiency is going to improve. You have another year of depreciation coming off of this equipment that Tesla's had. They've been building Model 3s for over 6 years. Model Y will be in its fourth full year of production, and basically you're losing. You're basically getting more units out of that same bit of capital. So the depreciation perspective, you're really driving that down.
Okay, so what we've just done is reviewed a number of factors that can impact the price and the cost favorably or unfavorably in terms of Tesla's 2024 margins. And James, he believes that at the end of the day, the margins for 2024 is going to improve. Because at the end of the day, it's kind of on balance. It's still going to be better for the margins. He thinks that Q4 2023 is going to be worse than Q3. So people are estimating that we're going to see auto gross margin reported in January to be lower, unless he's overestimating the impact of IRA going to point of sale. That's in January, though. So this will become more clear after Q1.
Yeah. He's missing a big green check, and I think we're going to go through it. next about Tesla's supply chain. I don't know if I'm in the camp of Q4 being worse. I got to think through that a little bit
No,
more
no.
than
He said
Q3.
the opposite. He thinks Q4 is going to be, oh, I'm sorry. Whoa. He thinks 2024 is going to be better. He thinks Q4 is going to be worse. Most people have said it's worse. You're saying you don't think Q4 auto gross margin is going to be worse?
I got to look at it a little bit more and understand the reasoning that people are using. And I need to study a little bit more.
Okay. So what do you think about 2024 though? Do you believe it's going to improve?
I do. The question is how quickly are rates going to come down, and what's the reason rates are going to come down? So I'm going to be very interested to see the U.S. auto SAR number. And I'm going to be very interested to hear and understand how the other automakers are talking about demand, because we've seen inventories build up from some of the other automakers, EV and non-EV. And we've now had a full year of being in full supply for the non-Tesla brands, where they were able to basically ship out and get rid of all that pent up demand and get people into vehicles. So, I mean, question is, are we going to hold a 16 million unit SAR in North America? We're going to hold a 16 million unit SAR in North America, and EV adoption is going to go from 8% to 12%. Well, then you're going to go from 1.3 or 2 or 3 million EVs in the US to 1.9, almost 2 million. And who's going to produce all those EVs if nobody else is adding capacity besides Tesla? So that's one thing that I think that's out there that could be, hopefully, it's all going to depend on the consumer. And does the consumer still have this appetite to get into new vehicles? And if they do, and Tesla's there to support them from a volume perspective, the pricing is still competitive. The IRA, I think, is a big thing, at point of sale. I mean, there could be some upside here. I know everybody's here. I've seen a lot of bearishness on 2024. So we'll see. I think the Cybertruck is going to be minimal in terms of its impact, both on the margin. I mean, it's going to be a net drag on margins, but the volumes are going to be pretty low. But when that product is at peak run rate, I think it's going to be the best gross margin vehicle that Tesla produces. I think the big thing we're a lot of people are missing in 2024 are the dynamics of how portfolio placement works in supply chain leverage and procurement negotiations. And we'll get into this topic next. I think we have a tweet to go through, but the thing that Tesla gets a 0 from analysts and from most people is the performance and capability of their supply chain. I think they have one of the best supply chains in the world. Gartner, who ranks supply chains, who's a professional firm in terms of understanding supply chain performance and effectiveness, rated them the number 14 supply chain in their top 25 list of thousands of companies in the world that were, they're number 14 on that list, and they're the top auto manufacturer. There was nobody above number 14. And Tesla, I think Tesla does not get the credit for its procurement leverage, its inventory turns, its innovation in manufacturing in terms of reducing labor, improving processing times, and improving output per square meter and making their manufacturing facilities more efficient, and their ability to navigate through these pandemics and these major supply chain challenges. That resiliency piece, that component of supply chain, is actually foundational to actually how they design their supply chain, how they multi-sourced, how they're, from a geography perspective, they're geographically redundant. There are many things that they do. They're local sourcing in Shanghai, for example. They're 95% locally sourced. That's very difficult to be that locally sourced to your factory. So the foundations of how they built their supply chain, they really get no credit. And it goes back right into this conversation about the ability to drive COGS down in 2024. I think that whole piece has been undercalled. And I think we got a tweet to look at.
Okay, let's go through your tweet that you mentioned. I think it's one of the biggest, most important messages for the Tesla investor. If most Tesla investors looking at Tesla, they're looking at the margins. And what you just said is that most people don't realize that the cost of goods, the supply chain, is what Tesla is able to do to have industry leading margins, and that it's being underestimated what could happen in 2024. So your tweet you sent out said partnering with Tesla has been a winning strategy for suppliers and partners. So any of the other suppliers who partner with Tesla, it's a winning strategy because every year, every time they have a new product, Tesla, as many times it's, every replacement platform that Tesla introduces, it becomes even bigger. So you say here that the Model 3.
Let's pause there for a
Go
second, really quick, Herbert, on the last slide. So what suppliers, if we go back to the last one, what suppliers look at is current suppliers of Tesla. They look at history and they look at the current and they look at the future. Prospective suppliers that want to fight for the Tesla business, look at their history, look at what's going on currently, and then they think about the future because they don't know the future because they're not a partner of Tesla. What does that mean? What that means is the current suppliers they have are fighting to stay as suppliers. And remember, Tesla has this CEO that's driving unbelievable efficiency throughout his teams, throughout the manufacturing operations, and that culture breeds down through his staff, and all the way down. And of course, that will bleed through to the supply chain leadership and into their procurement relationship. So everybody that is a supplier wants to hold on. They want to hold on because there's no other model that's built in higher volume in the world than the Tesla Model Y. And there's no other EV and there's no other auto product in the world that's built in higher volume. So they know that this company produced that. So if they get a part on that product, they're going to have the highest volume auto part that their business knows how to produce. If you're a supplier, that's very important, both for current suppliers and then the suppliers that are on the outside of the glass looking in. They're like, hey, I know Tesla has 2 suppliers for that, but maybe I can be the third coil spring supplier for Tesla, and I can supplant one of the top 2. So I'm going to come in at a really low cost, or I'm going to come in with these contract terms and inventory that are just going to be unbelievable. Like I'm going to give Tesla an offer that they can't refuse.
Yeah, because the scale matters. So go ahead and explain the next
scale
two
matters.
slides.
Yeah. So what's happening here, and it just is all tax, it's gobbledygook, but it really, you look at Model 3, it's 5 to 6x times the run rate of the S and X it replaced. It didn't replace those products, but it was another product after the S and X. The Model Y didn't replace the 3, but it was the next evolution. It's 2 times the run rate of the Model 3, and that's going to continue to grow, I believe. It's the number one, produced car in the world. The Cybertruck, the suppliers know that there's 1 million plus reservations, and it's probably going to be many times the current EV production market after a year. So I think the run rate that the Cybertruck will be at the end of 2024 will be greater than Rivian and Ford combined and what they're producing. Remember, there are suppliers feeding EV components to Rivian and Ford, and they're looking like, okay, well, Tesla's going to come in and I'm going to have one OEM to deal with. I'm going to have one model number to deal with. I'm not going to have these 14 different model numbers to deal with. And they're going to do the same probably combined volume and then continue to grow versus me having to deal with Rivian or Ford. I'm going to go fight for the Tesla business. I'm going to give them an offer they can't refuse. So it's not like Cybertruck's greater volume than the Model Y, but it's in that truck business. This segment's going to continue to grow. Then the big one is the compact. The compact vehicle, if that's going to be 4 to 5 times the Model Y, if it's going to be double the size of Tesla's entire current business, that's life-changing. That's business-changing forever for many of these suppliers and partners. I say suppliers, it's not only component suppliers, it could be partners they use for a number of different things, for services in the factory, for tooling shops, for fixturing, you name it. There's a number of suppliers and partners of Tesla that actually don't go in the physical vehicle, but think suppliers and partners, think compact being double the current size of the auto business. So what this is telling supplier, and then energy is tremendous reuse in terms of component reuse from what's inside of a Tesla vehicle today. And then
the battery, more than the battery.
More than the battery. Yeah,
Mm,
there's reuse from the inference computer, I believe. There's
mm,
reuse from other components that are in the energy side.
mm,
And then obviously we've talked about the bot on some videos, but this could be a product that is greater than $10,000 in MSRP. So there's a lot of suppliers involved. There's a lot of procurement leverage, the amount of spend. And if that reaches 100 million or 500 million a year annualized production run rate, I mean, it would be the single biggest thing of procurement leverage probably built anywhere. And so you take this, and what does it look like if you were to draw it out? It's just this rolling thing that continues to just grow and grow and grow. So if you're a supplier, you really want to either, if you're a current supplier of Tesla, you want more of this business. You want to stay in the fold. As they improve efficiency, you want to improve efficiency. When they ask you for cost downs, you want to give them cost downs. When they go to renegotiate with you on the contract, you want to figure out how to make it work for your business. And I think from my conversations, what I know about how supply chain works at Tesla, I view them as very tough and demanding on suppliers, but fair. And if you kind of hire the kind of talent, you have the kind of the statistical capability, and you kind of build your company in the mold of a Tesla and wanting to work with them, you can do very well as a supplier. So I view them as very fair. So I just think this whole piece is missed, that in the analyst community, that the amount of procurement and capital leverage that Tesla has. By the way, also resource leverage. Like, where are these people being hired from? Are there temps? Are there contracting agencies? Well, who's going to, hire as much labor as Tesla does in a particular region? This area of leverage is not only the components in the vehicle, it's all the services and partners of Tesla itself. And I can't think of a company where every product line that they do over successive years is the best, is the highest volume of anything out there, and continues to grow in size year over year. That you can look around in other industries, the computer industry, the smartphone industry. You can look at the current auto industry. The current auto industry is overcapacitized anywhere from 30 to 50%, depending on what region, US, Europe, China. And Tesla's in this position of, greater than 80% utilization, and just continuing to grow product line after product line. And the analyst community doesn't give them credit for that. That will directly translate to the rate of COGS reduction that Tesla is able to do versus their competition.
we should need to pause, think about it, absorb what you just said. This is a big one. This is a big point. And I appreciate you sharing this, and hope folks in the audience, your viewers, can understand this. Replay this. It's a big one. So talking about margins, the other thing that can impact margins is non-auto margins, because those typically have incredible margins. Not auto business revenue has tremendous
Yep.
margins and profits. So, this Alejandro Chavez, his post, people have no idea. Tesla's non-auto business contributed 510 million to gross profit last quarter. This is Apple all over again. This is the non-auto. So if we take a look at the table he put together, you've got the non-auto in blue, then you got the energy gross profits, and you got the services gross profit. Guess I'm a little confused, because is energy and services, are they add up together to become the non-auto, or non-auto something slightly different than these two? I'm trying to piece it together there.
Yeah, we may have to ask the author of that to clarify, but we know FSD is going up and to the right. We know energy is going up and to the right. And we know, there's services, other things that you can purchase on the vehicle, the entertainment packages and so forth. Those are all kind of going in the right direction. But really, it's energy and full self-driving. You have the also you have the supercharging. You have all these things. They're all going up and to the right. And so yeah, there is a bit of a story here. And I think what Elon, the leadership team, and the board believe is that, as they're kind of looking at these big blocks, maybe kind of like in 5 and 10 year chunks, they're going to see their hardware growth, continue to expand. They're going to get a lot of leverage, and they're going to take their cost structure down on hardware. And really the source of the gross margins is going to come from AI, and this real world AI of your vehicle being able to drive you and all the services that go around it, whether it's just full self-driving for you as a consumer, or whether it's robotaxi. Then there's a humanoid robot. Like the services and AI piece of it is where they see, super high gross margins, and of course the network dojo side of it as well. It's kind of a huge undertaking, and it's soaking up a lot of capital and a lot of spend. You've seen Tesla's OpEx margins come down rather significantly. One big input to that is obviously what they've done with MSRPs and their gross margins in auto. But the other big side that's soaking up OpEx is Tesla building up this massive dojo infrastructure, and they're doing the investments now, huge investments. No other automaker is doing this, and many computer companies aren't doing it at the scale yet that Tesla is doing this, and self-proclaimed AI companies are not doing it yet at the scale that Tesla is doing. So this is an arms race, and Tesla has many, many sources of revenue and margins, and their future projects and their future portfolio look like they're going to be just delivering much, much higher gross margins. So we'd like to microanalyze Q3 to Q4, Q2 to Q3 this year, and what's happening. Are we at a trough? Are we at a bottom? But when they step back and they look at it at a 5 to 10 year, the source of our margins are going to be less from hardware and more from the AI services that we provide.
So they're accomplishing quite a bit. Tesla is. What's confusing is their research and development, because like you said, they are investing significantly in Dojo and others, but they're much less. They're so efficient. It's much less than the other Magnificent Seven. Let's take a look at that. So this is Alexandra Mertz. She has this post, holy moly, showcasing Tesla's lean and mean efficiency again. Please compare research and development spend of the 6 of the Mag 7 Amazon does not report on the R&D. So here's the charts for each of the 6 for Q3 2023. So this is research and development and quarterly financials. And you can see, Q4 2022 to Q3 2024. What they spent was $3.7 billion, which is only, ranges from 3.3 to 5% of the percentage of revenues. Look at everybody else, 15%, 8%, 12%, 30%, 14%. So in terms of the percentage of revenue, Tesla has spent much less, and only 3.7 billion versus, look at these numbers here. I mean, some of them are 10 times, even higher than 10 times what Tesla's spending. What's your thoughts on this, Jeff? And help me figure out this table, beautiful, colorful, shows you where they're spending, but their R&D is so small, $1.28 billion for December 2023.
Yeah. So if we go back to the prior slide, one thing that Tesla is doing is they're growing their revenues, NVIDIA is obviously growing very fast as well. And you can see what's happened. NVIDIA's gone from, in a year, they've gone through 32% of revenue. They've cut it in half. And Tesla over the years has been growing their revenue pretty rapidly. But obviously, number one, they're very efficient in R&D. And if you look at the number of models that they've built to produce 2 million units of shipments of vehicles, there's nobody more efficient that's building that hardware at that MSRP with that few a number of models. So that's the one piece of it. And then Elon, prides himself on, very first principles thinking, including in labor, simplification in software development, simplification in hardware development. And he prides himself on that level of efficiency. So that's not as surprising when you see that. The one area I would have question, if we go to the detailed slide, is, and you see Tesla, number one, Tesla's percentage is ramping up. So they are ramping up their R&D spend as a percent, and their sales hasn't grown at the pace that it's grown at prior years. So their percentage number is coming up, but it's nowhere near the competition. So one of the areas that I would have a question on is, where is all this infrastructure spend from Dojo? Where is that going? If if they flipped it to production and it's actually doing training now on production data that's coming in from the field, well, then that will appear above gross margin. That won't appear in the R&D line. But anything that's not flipped over to production and doing production work should be in the R&D side. So we see the R&D piece of Tesla growing. They're going to go from basically a 3 billion unit or $3 billion annualized run rate. I think they're going to be closer to 5 billion. So they're really ramping that R&D spend up. And then once these AI solutions actually come out and start shipping, and you start seeing the FSD take rate go up, you eventually see robo-taxis and humanoid robots, you're going to see that percentage drop again rather dramatically. So that's what's happening. Highly efficient. Tesla's a highly efficient company on labor efficiency, R&D labor efficiency. They have few number of models in production. So that you don't have, you don't have the number of engineers Tesla having working on making 30 different versions. Remember the GM, we're going to do 30 different EVs for this year. Tesla's like, we're going to have 4. And, we're going to regionalize them for whatever variants we need for China, for here, for that. But we're going to do 4 core. We're going to support 4 core models, now going to 5 with Cybertruck. It's still nowhere near the amount of models that these other companies have. So that allows them to be very efficient in R&D, because every one of those new cars would be a new R&D program, would be a new prototyping program, would be new R&D spend to do it. And here Tesla does one Model Y in 2019, 2020. It's going to ship it for who knows how long, a decade. That's where you get a lot of the efficiencies from.
Yeah, clearly Tesla's doing something correctly. They're not wasting money. Anyways, this was an amazing episode. This is one for the books. We covered quite a bit, right? We talked about margins for 2024. You shared a lot of important information about the supply chain, what we're going to expect in the years to come, that as Tesla grows, in fact, the cost of goods is going to go down because they reuse parts, because of the scale is going to go up higher, and it's not being tracked at all by any of the analysts. And then we just showed how efficient they are with R&D, still being able to achieve things. Thank you so much, Jeff. This was powerful. Follow Jeff on X at @TheJeffLutz. Thank you, everybody. Bye-bye.
Thank you, Robert. Thanks, everyone.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.